Okay. So with the time that I have left today, let me go ahead and start this next section on the monetary system. All right. So let me ask you the following really easy question. If I were to ask you what money is, or to describe it, or even how would a child describe what money is, that child might describe it as, well, these are little green pieces of paper that mommy or daddy use to actually buy things with, right? Those green pieces of paper have these weird old guys portrayed on the front, and maybe some other strange looking buildings on the back, right? So at a very basic level, that's how we would describe our money. Just these little weird green pieces of paper. Well, let me ask you this. Which would you rather have? This green piece of paper here that has Abraham Lincoln on it and the number 5, or just some other random piece of paper that I have over here in my file? Those are not answers to any test questions, by the way. Which of those 2 pieces of paper would you rather have? The green one here with the 5 on it, or some piece of garbage in my manila folder? Sean?
I'd rather have $5.
Why?
I feel like I could get more for it than your trash.
I would hope you can, right? The reason why anyone with a pulse would rather have this piece of paper than this piece of paper is that you can actually exchange this one for things you care about, right? For things that actually have value to you, like other types of real goods and services, right? Sean, let me ask you another question. Which would you rather have? This little green piece of paper with a 5 on it, or let's say this green piece of paper with a 20 on it?
20.
Why? They're both green pieces of paper.
I mean, the 20 is just worth like 4 times as much.
You can buy, in other words, what you're saying here is that you can purchase more of the things that you really value with the Andrew Jackson than you can with the Abraham Lincoln, right? The total command of actual goods and services that this one has is larger than this one. Now, okay, let me ask you maybe a slightly more difficult question then, Sean. When you are, before you're actually buying something with one of these green pieces of paper, how can you be sure that the seller of the good or service that you're purchasing from is actually even going to be willing to accept these things called dollars? How can you be confident about that?
I mean, I've never had anyone tell me that they wouldn't accept it.
You just take all of these things for granted, right? Yeah, part of an econ principles class is to discover some of the mysteries of things that we all take for granted in our economy, right? The reason why I think we can all be confident that the seller will actually accept these things as a means of payment is because that seller in turn is confident that he or she can exchange these dollars, Sean, that we've just provided for goods and services that she may want at some point in the future, right? In other words, what we're saying here is that even though money itself has no intrinsic or inherent value, right? Everyone is willing to accept money as a means of payment that is in exchange for goods and services. Why? Because what money truly represents is nothing more than a claim to some future amount of consumption of goods and services. Sean, if you own one of these green pieces of paper with a 20 on it, essentially what that piece of paper says is this entitles Sean Corey, right, your last name? This entitles Sean Corey to $20 worth of consumption at some point in the future. That may be tomorrow, that may be next week, it may be 10 years from now. But what this represents is a claim to future consumption of goods and services. And that's why we value it, right? That's why we can be confident that people will accept it when we're trying to buy things, because they can turn around and use it as a claim to stuff that they value at some point in the future. So this section is called the monetary system. We're going to talk about the functions and the role of money in our economy, how money is related to our economy's central bank. So we'll also talk about the Federal Reserve in the course of this section. We'll also discuss how our economy's banking system is also related to the supply or the circulation of money in our economy as well. But we'll talk more about that here in a moment. Let me ask you another kind of abstract or more philosophical question here. I like these. Why do you think that the use of money as a kind of as a social custom for conducting transactions is actually so useful in a really complex economy like ours or like any other modern, highly developed economy? Why is the social custom of using money to actually buy things so very useful? Why?
But I think because of how flexible it is.
How flexible it is? What do you mean?
Well, like normally, say your neighbor has a goat and you want goat milk, you offer a chicken, but they don't want a chicken for it, but you still want your goat milk and you have nothing else that people buy.
I like the way Wyatt's thinking here, okay? What Wyatt is doing is he's imagining a world where there is no money, right? How on earth would we obtain the goods and services that we need to consume in a world where money doesn't exist, okay? What are you describing there? What kind of economic or monetary system?
They're bartering.
Exactly, that's barter, right? Without money, trade would require barter. That's the exchange of one good or service for another. The reason why barter is so difficult, or the reason why it is so kind of costly and inefficient, is because of something called the double coincidence of wants. All right, this is basically the unlikely occurrence that two people are going to magically have the other good that each other wants, right? If I have a watch, okay, and really what I'm in need of is a new suit for a job interview I'm going to go on when I get fired from this one, then I have to go out and find somebody that has a suit that I like. That suit has to fit me, right? And that person also must be in need of a watch and has to like the watch that I have. And we both have to regard the swap of the watch for the suit as being a fair trade, right? What is the improbable occurrence that all of those things are kind of naturally going to happen is what economists refer to as the double coincidence of wants, okay? In a barter system, because the double coincidence of wants is so difficult to attain, you might imagine that the total volume of trade in the economy is going to fall, and therefore production is going to fall, output and wages will fall, living standards will fall, etc. Okay? What money does is it eliminates all of these extra kind of search and resource costs that people would have to spend going around searching for suitable trading partners, right? Because we know that the seller will accept money, because the seller knows that when he tries to buy something in the future, the seller of that transaction will accept money, etc. Money kind of breaks down or eliminates all of these wasteful search costs that go on in a barter system where people are constantly kind of wandering around trying to find trading partners for the things that they're in need of. All right, that's the power and why money is so absolutely critical in a modern complex economy like the ones we participate in daily. Let me go ahead and state a kind of a formal definition of what economists refer to as money before we move on any further here. Money is defined not just as those green pieces of paper that I showed a picture of a few minutes ago, but money is the set of all of our assets that people regularly use to to buy goods and services with from other people, okay? An asset is any means of storing value over time, right? Lots of people have different types of assets in their portfolios, right? They have stocks and bonds. There are other physical assets like homes and cars and real estate. Money is one type of asset, all right, that helps us store value over time, which is I'll talk about a bit more in a minute, all right? The subset of all of our assets that we actually use to purchase goods and services with on a daily basis is what we refer to as money. So it does not include just those little green pieces of paper that we talked about a few minutes ago. It's also going to include other assets that we'll get to in a minute. All right, so let me talk about the kind of the three classic functions of money in an economy that I think you guys should be very familiar with. The first and primary function of money in an economy is to act as a medium of exchange. What is that? That is any item in which a buyer gives to a seller when they want to purchase goods and services, okay? If I were to go to, let's say, Lowe's or Home Depot and buy paint supplies, I need to paint the dining room walls, then when I purchased that good, the handover of money or the handover of cash from me, the buyer, to the retail clerk, the seller, allows the transaction to take place, right? In other words, money facilitates or makes easier this exchange of goods and services. It is the medium through which trade actually takes place in our economy. That is the primary kind of fundamental role of money in our economy. It's the stuff that we actually use to facilitate our transactions, the exchange of goods and services between one person and another. That is not the only role of money in our economy. It also serves what economists refer to as the unit of account, okay? The unit of account is, you can think of it basically as the yardstick or the metric that people use to post prices and also record debts in our economy. So all prices and all debts are recorded in whatever our unit of money is. In the United States, it would obviously be the US dollar, okay? When you guys go to the grocery store, you're going to find that a gallon of milk might cost $4. That is a price that is posted in dollars. You might also find that a bottle of Merlot costs $12, again, posted in US dollars. It would be equally correct, however, to say that a gallon of milk costs 1/3 of a bottle of wine, right? $4 divided by 12. It would be equally correct to say that one bottle of wine costs 3 gallons of milk, 12 divided by 4. You can imagine then that the prices of any good or service that you buy can essentially be quoted in terms of some other quantity of good or service that it would be tradable for. In other words, there would be almost an infinite number of different prices for each item that is sold in our economy. That would be unbelievably confusing for shoppers, right? In order for convenience and to standardize prices in terms of a single unit, what economies have elected to do is post all prices in a common unit. That is the unit of account. Here it is obviously US dollars. This is what we use to post prices as well as record our debts over time. That's the unit of account role that money facilitates. There is one more that is important, and I touched on this a little bit earlier, and that is money serves as a useful store of value, okay? What is that exactly? This is any item that people can use to transfer purchasing power from the present into the future. That's what we mean by a store of value. It's some item that you can use that enables you to kind of magically transfer purchasing power from the present into some point in the future, whether it's a day from now or a year from now or 10 years from now. Okay? How is money then a store of value? Well, when the seller of an item accepts dollars in exchange for goods, then that seller can hold those dollars and then become a buyer of another good or service in the future, whether that is in a day or two or a week or two. You can imagine that this cannot be accomplished as easily in a barter economy, right? If you were, Wyatt, to go back to one of your examples, if you were trying to barter goods and services, particularly, let's say if you exchange something for a perishable item and you received a perishable product, then you're going to have to consume that good relatively quickly before it goes bad. So attaining a store of value is somewhat difficult to do in a barter economy, right? Now, not all goods are perishable. So attaining a store of value in a barter economy is not impossible, but what would you have to do? You would have to basically build a warehouse to store all of these physical goods in over time, okay? It's much more efficient to simply store money and transfer your purchasing power over time that way. So one of the most important functions of money in our economy is to actually store value intertemporally, that is over time. Let me ask you this question. When do you think money is a bad store of value? Are there conditions when money would be a poor store of value? Sean?
If there's like high rates of inflation.
Yeah, why so? If inflation is high, if you live in a country with high inflation, why would money be a poor store of value?
You could accept it at one value and then if you I guess some time will pass and the money would be worth significantly less.
Right. So if we're living in a country with, let's say it has high inflation, then let's say the inflation rate is 10%. Then if I give you $1 today for some item, and you hold that dollar for a year and try to buy something with it, it's going to be 10% less valuable, right? So as inflation rises, the prices of all goods and services in our economy tend to go up as well, which means that the actual command that any single dollar is going to have over real goods and services goes down and down and down. So in high inflation economies, money loses its use as a store of value. This is why in some countries that have experienced extremely high rates of inflation, known as hyperinflation, people stop using the currency altogether and substitute it for something else, perhaps another country's currency or some other type of commodity, which we'll talk about here in a minute. I want you guys to be familiar with a couple of terms as it relates to money, because I'm going to use them over and over again and expect you guys to understand what I'm talking about here. First off is wealth. What do we mean by wealth? This is the total of all of our stores of value, minus our debts, to be exact. So wealth is defined as the value of all of your assets minus your liabilities or your debts, okay? Money is not the same thing as wealth. Money is the subset of these assets that we can use regularly to purchase goods and services with. You can be a very wealthy person and not actually have a lot of money. It's possible. It's highly unlikely, but it's possible, right? Matt, you could own 12 condos in Miami and would be considered very wealthy, even if you don't have much money in your checking account, right? Some people have a lot of money, but don't have a lot of wealth, right? Drug dealers, for example, walk around and carry hundreds, if not thousands of dollars with them at all times. But these individuals usually don't have a tremendous amount of wealth. They don't have houses and cars and portfolios of stocks and bonds. So be careful about that. People use these two terms synonymously, but they're not the same. Wealth is definitely not money. Wealth is the total amount of all of your assets minus your debts. Money is just those assets that you can use to purchase stuff with. What?
So, but aren't like goods that you could sell part of your wealth?
Yes, and that actually brings me to the second term I want to talk about, and that is liquidity. Okay, what does a macroeconomist mean by liquidity? This effectively describes how quickly or easily an asset can be turned into the economy's medium of exchange. Okay, so what are the most liquid assets that we have available? Money. They're already assets that are 100% liquid. They're perfectly liquid because they already exist in the form of our country's medium of exchange. Okay. There are other assets that are not perfectly liquid, but at least highly liquid, right? Your portfolio of stocks and bonds can be liquidated fairly quickly because those markets are really deep. You could sell them. You could tell your broker to sell them in a matter of minutes or hours. You could turn them into cash, right? How about homes? Homes are highly illiquid assets. It's much more difficult to turn a house into the economy's medium of exchange or money very quickly, right? It normally takes weeks, if not months, to sell a house. Now, let me just say one thing. Another way of thinking about this liquidity issue is that assets that are illiquid either take a long time to be converted into money or can be converted into money quickly only if the owner is willing to take on huge transactions costs, right? I'll give you an example. I bet you I could sell my house right now, which is worth a few $100,000 to somebody in this room. If I was willing to price my house to you for $500, I bet there's someone in here that would raise their hand and be willing to buy it from me today, okay? So although I can technically sell my house quickly, I would be experiencing huge transactions costs as a result of that. So that's the other way to think about liquidity, is either it's difficult to transform the asset into the medium of exchange, or you are subject to these large transactions costs. Did that kind of answer your question?
Oh yeah, I was just wondering whether or not you consider a drug dealer's drugs, like, well, since they can turn it into.
No, I would consider that the product that's being sold.
So that's what I was wondering. The product being sold, would you consider that an asset? Because by selling.
Well, I mean, sure. Once you accept dollars for that, then those dollars become part of your wealth, right? But the drugs are a perishable item that are going to be consumed right away. So I guess it depends on their use, right? If you intend to sell them, then the market value of them would be a part of your wealth, right? Okay, let me talk a couple of minutes about so we've talked about the main functions of money in our economy. I do want to mention, at least briefly here, the two different types of money that we have used in our economy at different points in time. The first one that I want to point out is what's referred to as a commodity money, okay? A commodity money is a type of money that takes the form of a specific commodity that actually has intrinsic or kind of inherent value, meaning that if you didn't use it to buy stuff with, it would have some other actual use to you, all right? The classic examples of commodity monies would be gold coins or other types of precious metals. Frequently you hear about different types of commodity monies emerging in prison populations, as an example, right? Ramen noodles. There's a pecan pralines from an article in The Guardian that I would encourage you to read. These are fascinating, about how prison inmates use these items as forms of commodity money. They're used, for instance, like packs of ramen noodles would be used within a prison to buy all sorts of things, toothpaste, deodorant, getting your hair cut or something, if you didn't have access to actual US dollars. but it's a commodity money because if you didn't use it to buy other products with, then you could actually eat it, right? That's the sense in which it's a commodity money. Gold is a commodity money because at one time we could use it in our economy to purchase goods and services with, but it had other uses, right? It's used in the jewelry industry as an example, sometimes in the dental industry. I'll just mention this, that for a long time in the United States, we were on something called the gold standard, meaning that we didn't actually use gold or gold coins in order to buy goods and services with, but rather what would happen is people would deposit their gold at an institution like a bank. The bank would then provide that depositor with notes that could be redeemable for a fixed amount of gold. Over time, you might imagine that people in the United States, instead of actually trading gold to buy goods and services with, would just start swapping the notes that were redeemable for a specific amount of gold, okay? When countries use paper currency that are backed by a specific amount of gold or some other precious metal, they're said to be on the gold or silver standard. We are no longer on that type of monetary system in this country, but for many years we actually were, and that was a type of commodity money. The type of monetary system that we are in these days, and all other major developed economies are in, as far as I know, is what's called fiat money. Fiat money, in contrast to commodity money, is a money that doesn't have any intrinsic value. Sean, if you didn't use that $20 bill to buy goods and services with, it would have absolutely no other functioning use for us at all, right? It has no other value other than to exchange for goods and services with. That's what we mean by a fiat money. It is used as money and is valued as money because of not its commodity value, but because of government decree. If you guys take a look at those green pieces of paper, that is our currency, there's a little phrase on there that says something like, "This note is legal tender for all debts, public and private." That's the government decreeing that this particular money has value for goods and services and for paying off debts. Now, let me ask you kind of a hypothetical question. Even though the government declares fiat money as valuable, does that necessarily mean that people in a country actually have to use fiat currency as a means of payment? Must we necessarily value it? No. If a country, for instance, experiences huge inflation, then like we talked about earlier, money loses its real value over goods and services, and people might substitute to a different type of money. So even though the government declares fiat money as being valuable, it doesn't necessarily have to be valuable in the eyes of the public. Okay, questions about that? So we know the three functions of money: medium of exchange, unit of account, store of value. And now we've talked about two different forms of money: commodity versus fiat. One has intrinsic value, the other doesn't. We used to be on the gold standard, a form of commodity money. Nowadays we have fiat money. All right, so let me spend a few minutes now talking about how we should actually measure the quantity of money that is in circulation in our economy, okay? That's what we mean, by the way, by the money supply or the stock of money in our economy. It's the quantity of money that is available in our economy to use to purchase goods and services with. The quantity of money that is circulating in the economy. Now, if we wanted to figure out what the money supply was for the US economy, then what assets would we need to include in our working definition of money? Well, I can think of a couple of obvious candidates, all right? The first one we've already talked about a lot today, and that is currency and coin. These are the paper bills and the coins in the hands of the non-bank public. So the total amount of currency and coin that is circulating around in the economy, we would want to include in our measure of the overall money supply. Now, let me emphasize this phrase here, the non-bank public. Why do I say that? Banks hold lots of currency in their bank vaults, right? That money that is in the bank vault is not technically part of the money supply because it is not readily available to purchase goods and services with by consumers. So it's the number of paper bills and coins circulating in the economy in the hands of the non-bank public. That's obviously one component that we would want to include in our measure of the money supply. But it's certainly not the only one. In fact, it's not even the major one. What other assets do we use to buy stuff with that we would want to include in our measure of the money supply? Can you guys think of anything else that you use to buy goods and services with? Yeah, fourth row here. Go ahead. A little louder. A check, right? And a check is withdrawn from what's called demand deposits. These are balances in bank accounts, in checking accounts that depositors have made that they can access on demand, either by writing a check or actually more often than not, swiping or inserting a debit card. So the total value of our checking account balances, what we call demand deposits, is certainly a part of the money supply. Demand deposits satisfy all the basic criteria of what money is. Is it a medium of exchange? Yes. You can use a check or a debit card to buy something. Is it a unit of account? Yes. It's posted and recorded in dollars. Is it a store of value? Absolutely. You can deposit funds into a checking account and keep them there to purchase goods and services with later. So our checking account balances, we would certainly want to include that in our country's measure of the money supply. Okay, the two most common measures of the money supply that I want you guys to be familiar with that are estimated by the Federal Reserve, which is the central bank of the United States, is the M1 money supply and the M2 money supply. The Fed is really creative with how they name these things. So we have M1 and M2, okay? What is the M1 money supply? How do we define it? This is basically the sum of all currency in the hands of the non-bank public, all of our demand deposits, and all other types of checkable deposits that we hold. And I have traveler's checks here, but that is really hardly anyone uses these anymore. So it's almost a very, very tiny fraction of the total M1 money supply. If you look at the data for July of 2020, the total M1 money supply in the US economy is about $5.3 trillion. And by the way, the biggest component of the M1 money supply are going to be demand deposits, right? The funds that you have on your account with various banks. Currency is not the largest component of the M1 money supply. One common feature of M1 is that, or I should say a couple of common features, is that all of the assets here are perfectly liquid. They can immediately be used to purchase goods and services with. And they're typically non-interest bearing assets. You don't earn any positive interest on any of these particular assets. Not quite true with M2. What does M2 stand for? This is essentially everything that is in M1, plus a few other categories. One are savings deposits, which most people earn a little bit of interest on. Other small time deposits, these are things called bank certificates of deposits, where you have to make a deposit and hold it in that account for a certain period of time, 6 months, a year, 2 years, whatever is specified on the bank CD or certificate of deposit. Money market mutual funds, and a few other minor categories. All of that stuff added together for July of 2020 in the US data was around $18.3 trillion. So the M2 money supply is significantly larger than the M1 money supply. Now, why would we want to include, for example, savings account balances in our measure of the money supply? Why does that make sense? Some people have the ability to write checks against their savings accounts. There are a few savings accounts that actually do that, but most people can't. Nevertheless, it's probably useful to include savings account balances in our measure of the money supply. Why? Because that asset is highly liquid. How difficult is it for you to transform savings account balances into checkable account balances? You click a mouse or tap an app on your phone, right? And it's super easy to transform savings accounts into checkable accounts, right? So while savings accounts are not perfectly liquid, they're highly, highly liquid, all right? When we want to consider a measure of the money supply that includes not just assets that are perfectly liquid, but also other assets that are at least highly liquid, like money market mutual funds and bank certificates of deposits, our measure of the money supply is going to broaden and expand. That's why we have these two different measures of the money supply. M1 is a narrow measure that includes only perfectly liquid assets. M2 is a broader measure that includes M1 and a few other categories of highly liquid assets. Now, I will say, as we go through the next several classes, this distinction between M1 and M2 is not often going to matter, particularly when we talk about a model of the money supply. I'm not going to draw this clear distinction, but I do want you to know the difference between M1 and M2, and in particular, what's included in M1 and some of the things that are included in M2, but not in M1. One thing I didn't mention here, credit cards. So that's a common means of payment, right? Should we put credit card limits in our measure of the money supply? Well, the answer is no, because you can see they're not part of M1 or M2. So let me rephrase the question. Why would we not want to include limits on credit card balances as a part of our money supply, you think? So even though we technically use credit cards to purchase things, they're not part of the money supply or the money stock for a very clear reason. Matt? How many people reach their limit? You'd be surprised. Are credit cards a means of paying for something, Matt, or a means of delaying payment until the future? Delaying payment. What is it when you use a credit card? What are you doing? You are taking out a loan. It is a fast-acting loan that you have to pay back in the future and at a high interest rate, right? So credit cards aren't really a means of payment. They're a means of delaying payment into the future. And so the total amount of credit card limits that we have in our economy, although that number is vast, we would not put that as a part of the money supply, but as a part of our, or at least the credit card balances then would be a part of our debt. All right, when an economy adopts a system of fiat money like we have in the US, then there's got to be an agency known as a central bank that's responsible for trying to regulate the banking system or oversee the banking system, as well as trying to manage or control the money supply. That is what a central bank is. It's this institution within our government that is responsible primarily for trying to manage the supply of money. When we have a fiat system of money that is valued because the government says so, there needs to be a government agency that is responsible for trying to manage the amount of money in circulation. That's what a central bank is. Monetary policy is the setting of the money supply by policymakers who work at the central bank. Okay? For those of you who go on to take more econ classes, perhaps you'll major in economics, you're going to talk a lot about differences between fiscal policy and monetary policy. Fiscal policy is the setting of things like taxes and government spending and government debt by the legislative branch of government. Monetary policy is the setting or the control or management of the money supply by policymakers who work directly for the central bank. So fiscal and monetary policy are done by two different agencies, okay? If Congress is in charge of fiscal policy in the US, it is the US Federal Reserve that is in charge of monetary policy. This is the name of our central bank here in the United States. In the amount of time I haven't left in class today, I want to talk a little bit about the structure of the Fed, okay? Just a little bit of background on this. The Fed was created by an act of Congress in 1914. And the reason why it was created is because in the United States, we had experienced for some 50 or 60 years a recurring set of what are called bank panics or bank failures. You guys know what a bank panic is? So a bank panic is a situation where lots of people run to the bank and try to withdraw their deposits at the same time, right? The reason why that is a big problem is because banks obviously don't keep all of those deposits in the form of reserves that are available to depositors on demand. What they do is they loan out a lot of those deposits to other investors, or banks purchase assets themselves. And so if everybody tries to run to the bank to withdraw their money at the same time, the bank is quickly going to run out of funds. The Federal Reserve was created in order to act as what's called a lender of last resort, meaning that commercial banks, if they're experiencing heavy withdrawals, can turn to the Federal Reserve to take out an emergency loan, okay? If we all knew that banks could access the Fed for lending, then that's going to prevent people from running to the bank and trying to withdraw all of their money at the same time. And it will hopefully avert these type of banking panics. That's why the Federal Reserve was originally created. It does a lot more, obviously, today than simply provide loans to banks. It conducts monetary policy on a regular basis, which we'll talk more about in the next class. But what I want to do in just the last few minutes today is talk about kind of the structure of our Federal Reserve system. First off, who runs the Fed? Who's in charge? Well, the Fed consists of three main, I'll call them pillars, okay? The first one is the Board of Governors. These are the guys that are most in charge, guys and gals, I should say. The Board of Governors consists of 7 members, and they are located in Washington, D.C. These 7 members are nominated or appointed by the President of the United States, but then they have to be confirmed by the Senate, okay? Now, you guys might know this, but currently we don't actually have 7 acting members of the Board of Governors. We only have 5. There are 2 people who have been appointed by the President, but have yet to be confirmed by the Senate. Judy Shelton is one of them, and the other is an economist, called an academic economist by the name of Christopher Waller. I'm not sure if either will get confirmed anytime soon. It's difficult to predict how the Senate is going to behave sometimes. What else do I want you to know about members of the Board of Governors? Board members are elected or appointed to serve one term and one term only that lasts 14 years. So whereas you're a congressman, serve 2-year terms and then have to be reelected. President serves 4-year terms, senators serve 6-year terms, members of the Board of Governors serve 14-year terms and can only serve 1 term. Why do you think the legislation that created the Federal Reserve insisted on these long terms in office for the Board of Governors? Why?
Because then they're not dependent on whatever political party puts them in power.
Exactly. Political insulation from outside pressure, right? If board members had to be reappointed frequently, then they might be beholden or unduly influenced by outside political forces. It's the same reason why we appoint Supreme Court justices to a lifetime tenure. We don't want them to be influenced by this kind of outside political pressure. We want our economic officials to have only the economy's long-term interests at heart, not other types of short-term political needs. Okay, so that's what it is. It helps the central bank be independent from the other branches of government. And another small thing I want to say about the Board of Governors: once these 7 members are confirmed, the President of the United States gets to select who the chairman and the vice chairman of the board are going to be. Okay. Right now, the chairman of the Board of Governors is this guy named Jerome Powell. He was appointed and confirmed in February of 2018 and will serve a 14-year term, unless he decides to resign before that, which sometimes happens. The second major pillar of the Federal Reserve System are the 12 regional or district Federal Reserve banks located around the country. If you guys click on this link, which I don't have time to do today, it takes you to a map that shows how the 12 districts are divided up in the United States. It looks kind of funny because some states are divided into 2 separate districts and whatnot. But the main thing I want you to know about the district banks is this is the arm of the Federal Reserve System that has contact directly with the private sector. When a commercial bank needs a loan from the Fed, it goes to one of these 12 district banks to take out that loan. We are in the Atlanta district. So if Regions Bank here locally needed an emergency loan from the Federal Reserve, it would go to the Federal Reserve Bank of Atlanta to take out that loan, not to the Board of Governors in Washington, D.C. Last thing I want to talk about is this Federal Open Market Committee. This is the third major pillar of the Federal Reserve System. This committee is the actual body that makes monetary policy decisions. Once about every 6 weeks or so, this committee gets together in Washington, D.C. It discusses the outlook for the economy, and then it decides on what monetary policy measures to take, how it should change interest rates to move the money supply up or down. Okay. The Federal Open Market Committee, which I'll talk more about in the next class, includes the 7 board members of the Board of Governors, plus it includes 5 of the district bank presidents across the country. Now, obviously, there are 12 district banks, so only 5 of the bank presidents are going to be voting members at any one time. So voting members kind of rotate on an annual basis, with one exception that I want you to know about. And that is the president of the District Bank of New York is always a voting member on the FOMC. So the other 4 rotate from the other 11 district banks. The reason why the New York Fed president is always a voting member is because of the special role that the New York Fed plays in monetary policy. When the Fed makes a monetary policy decision, it has to interact with certain Wall Street players, and the arm of the Federal Reserve that actually does that interaction is the Federal Reserve Bank of New York. And so because of its significant influence within the Federal Reserve System, the bank president of New York is always a voting member of the FOMC. Okay, in the next class, we're going to spend a lot of time talking about how the private banking system can affect the money supply in our economy. And then we're also going to come back and revisit the Federal Reserve and talk about some of the modern ways in which the FOMC in particular actually conducts monetary policy. And then we'll be through with this section, okay? So I will see you guys on Thursday.